Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And this series is all about using charts to plan and place trades of different varieties, trend trades and swing trades. But one thing about charting is it can get kind of cluttered. There can be a lot of noise on a chart. And so today we're going to be using a couple of indicators that actually employ a technique known as double smoothing in an effort to slow down that noise, to reduce the clutter. We're going to be building a strategy using the triangular moving average and the true trend strength index. There we go. I knew those were going to be a little bit to get out, but we got it done. Should be a really interesting discussion, though. Let me first of all, before we dive into that, say hello to everybody who's already chatting in. Great to see all the familiar names. Nice to see some new names as well. But hello there, Curtis and Mighty Mouse, Janelle, Jim, Scott, Kevin, Selva, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. As I always say, that's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Friday webcast series, and we kick things off promptly at 1 o'clock Eastern time. Now, I also want to let those of you know, those of you that are here in the live stream audience know that I'm joined by my very good friend, Ben Watson. Ben's going to be hanging out in the chats. He's going to be keeping an eye on the questions that come in, and if I can't get to those, Ben's there to pick up my slack for me. Thanks for having my back there, Ben. Ben and I would also like to issue an invitation to everyone listening live or on the recording to follow us on social media. You can follow Ben and me on X. Ben can be found on X at Ben Watson CS. You can find him there you can find me there at Cameron May CS. Or you can also now follow us both on LinkedIn. Just go to linkedin.com/in. And then for Ben, it's /Ben Watson CS. And for me, my username is Cameron May CS. So /Cameron May CS before that or after that traditional LinkedIn prefix. But guys, let's get into this discussion. Really looking forward to this one. It's all about reducing the chart noise. Now, as we go to that, of course, we need to bear in mind the fact that any technical approach carries risks. So we need to be aware of this. Keep these disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for today's discussion. As we do each week, because this webcast is part of an ongoing series of discussions, we already have some trades in place. So we're going to take a look at some example trades. We'll quickly recap the technical logic for those trades, just see how they're coming along, see if there's anything that we need to do with those. Then we're going to take a peek at what's going on with the S&P 500 through the lens of our trend value momentum strategy set. It's a set of technical indicators that we use each week to introduce some continuity from webcast to webcast. Anyway, just get a gauge of whether we're still dealing with bullish conditions or the market's turning. We'll take a look at that, but then we'll use that as the backdrop for planning and placing a new trade today. And today we're going to be doing a swing trade, but we're going to be constructing that using a combination of two technical indicators, one that should be familiar to viewers of this webcast series, one that's probably going to be brand new to just about everybody. But with both of those, they employ a technique known as double smoothing, sometimes used by technicians to smooth up that chart noise, and hopefully, not always, but hopefully provide a higher quality but maybe less frequent technical signal to trade on. That's the objective. We'll see if it plays out in this case, but it should be interesting building it on those two indicators. But let's go right to our paper money platform. Let's have a look at our two positions that we have right now. We have last week's trade, General Electric. Looks like it's doing fine, up about $700 on 100 shares. McKesson, we didn't buy nearly as many shares, but it's still also doing well. We've ramped up the amount that we're spending on each trade this year. Okay, so let's start with General Electric. Let's go to our charts. Here's our GE trade. You can see there's a blue oval indicating this is when we took our trade. So I said last week. Actually, last week was a holiday shortened trading session, so we didn't have this webcast. So it was actually 2 weeks ago when we took this trade. And that was on the technical evidence of a weekly and daily PPO crossover. We saw that daily crossing over the weekly, got our signal just a couple of weeks ago. It was a bullish signal with a plan to take, we took an entry, plan to exit on a bearish crossover. That would be if our green line basically is crossing back down over our red. Now I recognize not everybody was here 2 weeks ago to see this discussion. So if you want to catch up on any of the webcasts that we've had in the past, explore any of the topics that we've covered in the past, make sure that you do yourselves a favor and subscribe to our Trader Talks channel on YouTube. The full name of that channel is Trader Talks Schwab Coaching Webcasts. And this is where you can join our live streams, but you can also find playlists of previous webcasts, including, this discussion from 2 weeks ago. So if I go to playlists, go about halfway down the page, I'll find a little bit further down. There's me. There's my advanced charting techniques playlist, and I can view the full playlist right here. And I can see that discussion, trading stock momentum with the weekly and daily PPO indicator. So you can see how that indicator is built, the logic of the trade, and how we're planning to take any profits or losses, depending on which one manifests itself right now. Seems like we have unrealized gains. So that one looks fine. GE doing well. Now let's go to McKesson. So how about we just bring up the chart of McKesson? Let's load up our McKesson study set. And that was the zigzag high-low indicator. So sometimes a stock zigs bullishly, sometimes it zags bearishly, and on it goes. So we discussed the construction of this indicator. We talked about how it might be used to generate short-term to maybe intermediate-term signals. And we entered on a bullish zig, waiting now for a bearish zag. We're gonna sell if this reverses and starts to head lower. We haven't seen that yet, so that position is hanging in there. We're gonna let that one continue to work. So those are our two trades. And of course, where might you go if you didn't see that discussion? It's right here, swing trading with the zigzag high-low indicator. All right, so now let's shift our attention to the markets. Kicking off 2026, I know there's been plenty of talk about something known as the Santa Claus rally. Has it actually happened? Let's go to the charts. Let's bring up SPX, and let's switch up our strategy set to the TVM, standing for Trend, Value, Momentum. 3 different types of indicators. Our Trend, Value, Momentum strategy set. So we have a trend indicator, which is 2 triangular moving averages. We have the value indicator, which is the RSI, and our momentum indicator, which is our MACD. And a trader here using this sort of an approach might be looking to see, well, are we seeing bullish or bearish indications from these? Yeah, Jay Richardson says Santa is missing in action. Cecil says not so much. Yeah, if we wanted to see a traditional Santa rally, here's an important reference point. So I'll get to the TVM here in just a moment. But December 23rd was the 6th trading day before the end of the year. And a typical Santa rally is usually an expectation that the markets will go up net over the course of the final 5 days of the year and transitioning into the first 2 days of the next year. So that would mean that in order for this to count as a Santa rally, using that traditional definition, we need to get above, by tomorrow, get above and close above the high, not the high, but the close of December 23rd. Right now, we have not seen a net increase on the S&P 500 at least, trading below that benchmark. So yeah, we need to see a pretty good rally at this point. Not an enormous rally, but a pretty good one. What would that require? We need to get up from here. Let me just use our trend line tool as a measuring device. We need to get up to about here. That looks like that's about 1.14%. We need some news probably to kick things into gear, but it's looking kind of unlikely at this point. Let me just remove that drawing. Let's zoom back out and look at the TVM. Now, just because Santa didn't show up, just because we kind of got a lump of coal, does that mean that we have a reversal of the bullish market that we've been enjoying since April? That doesn't look like the case either. So for our TVM trader, for the strength of the trend, they might be looking for the 50-period triangular moving average to remain above the 100-period triangular moving average. That's exactly where it is. There's been a little bit of softening, kind of a narrowing of the distance between the two. So maybe the trends aren't quite as strong as they've been, but still net bullish despite primarily bearish behavior from the S&P 500 component stocks over the last 5 days. But I'm still going to put a check in the list for the bulls for trend. Okay, Jay Richardson says it looks like there might be a double top forming. I think you would probably be looking at this one and then go all the way back here to this one. If that's the case, a trader might be looking for a break below the lowest point between those two peaks. It would probably be this 65.20. Yeah, but overall, higher highs and higher lows still appear to be intact. The 50 triangular still above the 100. Trends still look strong despite this little bit of a pullback that we've seen. Now that, again, we might continue going down, but just through that one technical lens, we might still check for bullish. What about RSI? We've been coming down over the same period, maybe a little bit earlier than stocks, but here's one thing that a trader might note. A technician looking at this short-term indications of value, we might be dipping down, but overall, lows have still been rising. For RSI, traditionally, that would still be a bullish confirmation. Even the highs have still managed to creep a little bit higher. Not as rapidly, but that's kind of a reflection of what we've seen on the markets in general. So I'm going to say check for the bulls here, check for the bulls there. Let's remove our drawings here. Now the bears might be getting one vote here from our momentum oscillator. The MACD histogram got a kind of a soft peak here and has sagged back down below that zero line, that signal line. So this could be a shift to short-term bearish momentum right there. So that might be check for the bulls, check for the bulls, check for the bears there. So a little bit of a mixed bag, but overall, looks like still continued technical bullishness, at least through this technical lens. And we'll say that that's the backdrop now for the trade that we're going to be planning and placing today. We're just going to be doing a stock trade, but building it using a system that's been very carefully constructed to try to minimize chart noise. And the system that we're going to start with actually begins with the triangular moving average that we're already seeing on our chart. We're just going to use a little bit of a different one. So let me go to I'm going to go to an individual stock, a different chart. Let's bring up Bank of America here, and I'm going to clean up our indicators. Let's go, I'm going to start from a clean slate. I think that's typically useful. So how about we do this? Let's go to studies. Let's just remove all of our studies. Nice clean chart. But I'm going to add back a triangular moving average. But previously we've been looking at a 50 or 100. In this case, let's add a triangular moving average. Let's spell it correctly. There we go. Let's select moving average triangular, add that to our chart. But let's set a time frame of 200 days. Now we're on a daily chart, so the period length here is a day, so we're going to go with 200 days. Janelle is saying, who will win, the bulls or bears? Yeah, we'll see, Janelle, but all I can say is at this moment, the bulls seem to still have a pretty strong upper hand. The bears may be asserting that command starting 5 days ago. That would be pretty early, though. We'll see. In any case, let's add a 200-period triangular moving average. And as I do, let me click OK and click Apply. That's going to give us a typical moving average line on our chart. But not everybody. How many do we have watching? 203 people watching the live stream right now. Not everybody knows what a triangular moving average is, and I don't mind revisiting this. This is something that we've covered a number of times in the past. It's not a tough one to explain. Most people are familiar with a simple moving average. Just a trend line that's applied to the chart that connects average closing values over a given time frame. So if we were looking at 200 days, it would be the average closing value over the last 200 days, and that just changes from day to day. So it creates a line. That's a simple moving average. A triangular moving average smooths out a simple moving average. And the way it does that is it creates a moving average of the moving average. So for a traditional simple moving average, if we were looking at the 200 day, we'd look at the closing values for, let's say, Bank of America. For each of the last 200 days, we just add them all up, divide by 200, and that gives us the average, and we plot that on the chart, and then just repeat that every day. That creates that moving average. So really, what the simple moving average is attempting to do is to smooth out price activity. And it does a pretty fair job of that. Doesn't mean it always produces profitable trading outcomes, but that's one of the intended purposes of using a moving average by a technician. Well, a triangular moving average, instead of using closing values each day, it uses the moving average value for each day. And then we just add those up for the period, divide that by the period length, like 200, and then we plot that on the chart. So it is a double smoothing. And as the first smoothing being the fact that the simple moving average smoothed out price, and then the triangular moving average smooths out the moving average. Okay? So for some traders, that might give an even smoother view of trend and produce not as many trend shifts, not as many crossover signals, but hopefully signals of higher quality. That's the objective. Obviously, quality is determined by what the trade does after an entry, but that's what we call a double smoothed indicator. It's one that we've used in the past. So here's the one that we have right now. So as we look at this, a couple of potential applications for our 200 period triangular moving average is, number one, it might act as potential areas of support or resistance. Number two is it might be an indication of trend, and that's how we're going to employ it today. We just want a smoothed out version of what's going on with the trend. You can see how choppy Bank of America has been. Well, that has been smoothed out twice, and we can now see the very smooth visual presentation of our triangular moving average. So for our trader here, let's just say that as long as that price is rising above that 200 period triangular moving average, that may be an indication of longer term bullishness. Now, even within a longer term bullish trend, a swing trader might see times where entry is less optimal and times where entry is more optimal, and they might want to zero in on maybe trading at or near short-term lows and hopefully exiting at or near short-term highs. Now, they might use price for that, but price can be very choppy. Price can be very noisy. So some days we see red candles, other days we'll see white candles, and you can see it just chopping back and forth. So in an effort to smooth that out and provide maybe potentially clearer entry signals, they might recruit a second indicator. And that's going to be the one that I think is going to be new to so many people. We're going to use the True Strength Index. Thinking back on how I launched this webcast, I'm not even sure I said it correctly. Did I sort of stumble over my tongue? The True Strength Index, TSI. Anyway, how many of you are familiar with the True Strength Index? Chat in, let me know. As I add this to our chart, let's go to our study set, or to our studies. Let's type in true. There's our True Strength Index. Let's add that to our chart. And right here, we can see the hints of the construction of the indicator. 25, 13, 8, and exponential should be a familiar term to most people watching. Wild Goose, you haven't heard of this one? Kevin, Jill, nope. Richard, no. You're going to see a lot of physical similarities between this and last week's discussion, the weekly and daily PPO. Kind of similar, but smoother. Okay, looks like not a single person has heard of this one before. That's interesting. Okay, well, let's add this to our chart, but I wanted to note this. This will still be visible on our chart, but 25, 13, 8, and exponential. Those are very insightful into how this indicator is constructed. I'm going to apply those to our chart and click OK, and that's going to show us this oscillator that right now has two lines. We're going to be adding a third line in just a moment. Just know that if you're following along and you're seeing me in a few minutes using three lines and you wonder where the third line came from, it has to be added manually. Okay? But right now we're seeing what's known as the zero line and the TSI line. But basically, this all starts. Lola, you like this? You say Cameron always brings new tools. You love this class. That's good. I'm glad you find it helpful. But yeah, this indicator starts life as an exponential moving average. So an exponential moving average is already a somewhat, I might even call this a triple smoothed indicator. Might even extend beyond that once we add the third line. But in any case, if you can envision this, we start off with a 25-period exponential moving average. But this is not just any old exponential moving average. A typical exponential moving average, like a simple moving average, just looks at closing values from day to day. Did price go up or did it go down? The TSI, though, uses a different baseline number. It's not the close. Instead, it uses a net change from close to close. So instead of looking, at let's look at yesterday. Yesterday, Bank of America closed at 55 on the nose. That's interesting. The day before, it closed at 55.28. So for an exponential moving average, we'd add 55.28 to 55. Not with the TSI. Instead, we look at the change. In this case, it would be a minus 28-cent change. So we take that as our starting value, and then we get an exponential moving average of those changes in price over 25 days. That's it. So it's an exponential moving average of change in price over 25 days. The very significant impact of using the change in price rather than just using price is that it will orient this indicator along a horizontal axis, because sometimes those changes are net positive, sometimes their changes are, let's reverse it. Yeah, sometimes those changes are net negative over a 25-day time frame. So they'll tend to oscillate above and below a zero line. Okay, so we take that 25-period exponential moving average of those net changes, and then the indicator smooths that again. It takes a 13-period exponential moving average of the original 25. Ooh, that's getting kind of layered, but the bottom line here is we're just attempting to smooth out that price activity and position it along this horizontal axis. Is it net going up or is it net going down? And we want to smooth out just an individual day's impact on that net change, make it a little bit clearer. Now, there's a final element here that is not displayed on our chart. Okay, we now know that the TSI line is basically this double smooth exponential moving average of price changes. The zero line is just the net change over a 25-day time frame. Now, finally, well, it's a net change over a 25-day trailing time frame anyway. The final number here, though, is a third moving average. And for this, we need to add it to the chart. It says 8. Yeah. Let's go up here to our indicator, go to our true strength index, click on the little customized gear icon, and we're going to go to what's known as the signal line. Now notice this is purple. There's nothing purple on our chart right now. So I'm going to check show plot for this third line, click OK and click apply, click OK again, and now we have an 8-period exponential moving average of the TSI line. There we go. We now understand how this indicator is built. It's It's not just doubled. It's actually not just tripled. Although if you were to read, get on Google and search this up, it will say it's a double smoothed indicator. In my view, it's about a step beyond that. It's like a triple smooth indicator because the 25 period, that's your first smoothing. The 13 period, that's a second smoothing. And then it interacts with a third smooth period. That's our 8 exponential moving average. So here's if we follow the logic of this, it's a smoothed out version of the day-to-day changes in price that's actually just been smoothed at least twice, and in the case of the purple line, 3 times. And then we're looking at the interplay of the TSI versus its 8-day moving average as potential signals of changes, potentially important changes in that net price activity. Okay, so here, with that as setting the stage for the trading of the indicator, I know that some people like to know how an indicator is built. There's kind of a high-level explanation of how this is built. Obviously, if you want to see more of those inner workings and specific calculations, if you're not familiar with those, you can just Google it. But how is it traded? Well, like with so many other moving averages, crossovers can be used for the planning and placing of swing trades. So let's look at the interplay of our green TSI line with our purple signal line. And we want to employ the longer term trend line as identified by this triangular moving average. So our trader who is looking for a smooth version of what's happening with a stock, they might look at our triangular moving average first and just make sure that price is above that before we even begin to look for bullish trade entries. Now, for the signal that it's time to get in, using this approach, they would typically look for a crossover of the green TSI line moving above its 8-period moving average. And you can see that happening most recently on Bank of America right there. It looks like that was around November 28th. There was a crossover right here. And a typical exit on this would be a crossover in the other direction, a bearish TSI crossover, which looks like that happened about right there. In this case, it turned out to be a profitable trade, not an enormously profitable one, but that's a pretty good description of a lot of swing trading approaches. Not looking for huge profits, just smaller profits that hopefully add up relatively quickly over time. So let me see. Sia says, Cameron, the lag is pretty tight on TSI. It is, Sia, yeah. Now, how could a trader could, if they wanted to, they could even slow down the generation of trade signals using this oscillator. We've already smoothed our trend through a couple of layers, but if we wanted to slow all this down, what could we do? Well, we could use, for example, a longer exponential or a longer final moving average on our signal line. Could do that. I'm not going to do that today, but yeah, using larger numbers or longer data sets will tend to slow a signal down. So if our trader is okay with the smoothing that has already happened, but they want to apply some of their own additional smoothing, they might try doing that. And then just go back through a series of charts and see if it seems to be working for that trader. All right, so that is a typical swing trade, getting in on a bullish crossover, exiting, taking profits if profits have shown up on a bearish crossover, but that's if the trade works. Some of these trades don't work. In this case, it did. Where might a trader take their lumps or their losses? Well, most commonly, when there is a bullish crossover generated, it's because there's been a net change in prices over time. We're starting to see those prices rise, and that brings them up off of recent floors. So a trader might look back, and if we start to get below those recent floors at all, this is a very common technique when trading oscillators, is to look back to previous lows or the most recent lows and go just below that. So in this case, yeah, it might have been a profitable trade, but actually the reward to risk looked like it only worked out to maybe about a 1-to-1. So is it a perfect trading system? Nope, there isn't one that I can deliver. I wish I could. But let's see if there is another recent signal. There was a signal here on a crossover, an exit there. That one looks like it was probably profitable. Here's a crossover here. There's a near miss on a couple of occasions there, and then a bearish crossover there. So in this case, that looked like that was a pretty good trade. This one would have been an example of a failed trade. So we might have had a stop down below this previous low, but the crossover, the bearish crossover, actually happened well before that. So we might have minimized the loss in that way. But guys, that is that's a trade system for swing traders using 2 double smoothed, or in my view, even 1 triple smoothed indicator. But before we go place today's trade, and I am going to do a scan for current trade examples, I do want to talk about a different way this is sometimes used. So Paul says, how does it compare to parabolic SAR? It's always a fair question, Paul. You know, when somebody says, how does this compare to that? I don't like to do the comparisons in these webcasts, though, because in order for me to do any kind of fair justice to that sort of a question, I've already explained how the True Strength Index is built. In order to understand the differences between this indicator and another one, we then have to discuss how the other one's built and how it generates entry and exit signals, and then compare and contrast those. That's 45 minutes right there. So it's a good question. I think what I'd suggest you do if you're interested in a comparison of those is bring them up on a chart, explore them on your own, look at the definitions so you understand the inner workings of them as well. But I can just say that with lots of oscillating indicators, there are definitely some strong similarities, but there are also some significant differences in their construction. All right, so back to our second potential approach. This is more of a trend trading approach. And interestingly enough, the trend trading approach doesn't actually employ the trend indicator. For traders of the True Strength Index who are looking to trade the trend, they may actually just look for a different kind of crossover, and that is, let me clean this one up for just a little bit. I'm going to take this one off. Let's remove this drawing and this one. And in this case, they're looking for the TSI line, the green line, to be crossing above. Oops, don't want to draw a line there. Let's change that to an oval. But they're basically looking for the TSI line to have weakened sufficiently that it's moved into net negative territory, and then watch for that to strengthen significantly enough that it crosses back into net positive territory. And that's known as a bullish zero line crossover. And that can signal an entry, and that looks like that might have been right around here on our stock chart. And the exit is just when we get the opposite. And it looks like there's a little bit of a whipsaw out and back in right here. And another whipsaw right there, out and back in right there. That can happen. Yeah, but that sort of a crossover, you can see it doesn't happen as often. In this case, we've had a few on our chart. But the objective here is to capture larger trends to the upside if those develop. But the approach that we're going to be taking today is going to be from the perspective of the swing trader. So I want to go look for a swing trade setup using the scan filter on Thinkorswim. So let's switch over to our live platform. We're going to be looking for a study filter scan, and the study filters are only available on the live platform. So when you see my color scheming change like that from light to dark, it means I just switched over. I had both platforms open, the Paper Money and an example live account, and I just switched over to live. All right, so we're going to be looking for a combination of 2 indicators, and they're both technical studies, so we're going to be using the study filter right up here in the upper right. We're not actually going to be using the stock filters, so let's close these out. But let's do scan in the S&P 500. So let's see if we can find any S&P 500 component companies that are showing a current, meaning right now today, crossover of our TSI crossing above our signal line while price is above the 200 period triangular moving average. So to do that, let's go to add filter and let's add two of them. Two study filters. The first one, let's take care of price. So I'm going to go to a custom filter. And in this case, let's delete our ADX crossover. Let's add a price condition. So specifically, let's look for a closing price that is greater than our triangular moving average. So our triangular moving average is a study. Let's look for triangular. There it is. Let's choose our study time frame. That's a length of 200 days. And this is our signal recency. So we want our price, our closing price, to be greater than our 200 triangular moving average within 1 bar. That means within today's bar, within basically a 24-hour period. So let's click Save. So that's going to require that price is above the 200 period triangular moving average. Now, let's add a second requirement to our filter. Let's do another custom filter. Doesn't involve the ADX crossover, so we'll just delete that. And we're going to add a second study condition in this case. And this is for our true strength indicator. Let's choose TSI. And for this, we want the TSI line. So notice we have a choice of the 3 lines. The green TSI line, we have the purple signal line, and we have the red 0 line. Let's choose our green TSI line is crossing above. Let's choose our study. Again, another element of the true strength index, but in this case, we want it to be crossing above our purple signal line. There we go. Now, how recently do we want that to have happen? Let's look for something happening today. This is going to be kind of unusual. So price above the 200 period triangular moving average and our TSI crossing above our signal line. But let's click Save. Let's click OK. So notice true strength index, TSI is crossing above the signal line. Green over purple, exactly right. See ya? Let's click OK. And let's click Scan. So this is going to scan through the 500 companies that make up the S&P 500. And it looks like how many? Maybe a dozen are showing current signals. There's a INTC. How about we use that for today's example trade? Let's go to INTC. See what's going on with this? First of all, let's just confirm that the scan has done its job. Is price above the 200 simple or triangular moving average? It is. Yep. Now, is our TSI line, the green line, crossing above the purple line? It is. So I'm going to be building today's trade based on this entry with a plan to exit if we get a bearish crossover or if price happens to fall back down below this recent low. So we're going to have a stop down there just below 35. Maybe we'll call it 34. All right. Now, before I do that, how about I do this? I know some of you are probably saying, okay, Cameron, could you just maybe please kind of share that scan? Yep. There's the request just came in. Let's do that. Oops, wrong one. Let's click on the right menu. Let's, should I save this? I'm going to save it first for future use. Let's click on Save Scan Query, and I'm just going to call this the TSI plus TMA. So our true strength index plus the triangular moving average. Click Save. And now let's share it. Okay. And I'm going to post that into chat. And just, of course, be advised that shared scans are not guaranteed as to timing or accuracy. Also, let me add that I'm going to put a reminder in my notes to include that in my, there we go. In my video description after the webcast is over, I always write a description. I put it down below the webcast. So if you're watching on the recording, you can find this scan link down below. Okay. So let's go back and let's go place our trade. So we're just going to buy some Intel Corporation. Plan is going to be to exit down here at $34 with a stop. Otherwise, the other plan is going to be to sell on, I think I'll leave it just sort of grammatically correct with just lowercase words here. Sell on bearish crossover. Go. Let's edit that to blue, neutral, because we don't know when or if that's going to happen. And let's go place our trade. So go to our trade tab. Let's buy 100 shares of Intel. That'd be about a $3,900 trade. We're going to right click on that and put in a custom order with a stop to buy 100 shares at, let's buy it at the current market price. Our stop order we're going to put in at $34. There we go. Make sure that stop order is good till canceled. And we're going to click confirm and send. And obviously when we put in a market order, there's a risk we might not be thrilled with the price that we have to pay. We're not guaranteed that we'll buy for exactly $39.29 or $39.30. But we're going to put it in order to buy 100 shares. We have our stop at $34. The stop is not a guarantee that we'll sell for it exactly $34. That's just our trigger price. And there's no commission on this trade, but there can be on some types of trades. But let's send this order off. And we should get a pretty quick fill here. There it is. Bought those shares at $39.32. Okay, guys, we've accomplished what I set out to do today. I wanted to talk through an approach that might be employed by a trader who's just looking to quiet the noise on a chart. So we've employed two technical indicators that use double smoothing in their construction, hopefully to just, calm that noise and show a little bit clearer signals to the trader. Now, clearer signals, not a guarantee of performance, but this will be interesting to follow up on this in a future webcast. We'll see how this one goes. But we've talked through how these indicators are built. We're talking through how they might be used to construct a trading system for swing trading of stocks with the double smoothing effect. So we'll see if that turns out to be a profitable effect or not. But guys, time for me to let you go. I hope you're enjoying your holidays. I'm going to be back on Monday, just normal working hours on Monday. Markets are back in full swing now. So I'll see you on Monday, but I also want to issue an invitation to you to make sure that you're taking advantage of the full slate of educational resources that are made available to you from Schwab Education. So first of all, if you haven't subscribed to our Trader Talks channel yet on YouTube, make sure you do that. So Trader Talks Schwab Coaching Webcasts is that YouTube channel. You can subscribe by clicking the subscribe button right down below the video right now. It only takes a second. It doesn't cost anything, but this is where you can join our live streams. This is where you can find our playlists. Now, another thing that Ben and I would suggest that you do, strongly suggest that you follow us on social media. You can find Ben and me on X. You can find Ben on X at Ben Watson CS. You can find me here at Cameron May CS. And when you reply to one of my posts here, I try to reply right back to you. Like I just asked this question, is there going to be a Santa rally? I think most people said no. Looks like it's likely not going to happen. We still have a day to get course corrected, but running out of time. But if you reply to one of my posts, this allows for interaction when it's not otherwise available, when the cameras aren't on. Now, the one other place that you can now connect with Ben and with me is on LinkedIn. So you can find Ben on LinkedIn. You just go to linkedin.com/in and then put another slash, and his would be Ben Watson CS. My handle here is Cameron May CS. That'll take you right to my profile, and then you can just give me a follow there. But same deal here. If you follow him here, If you reply to one of my posts, I just try to reply right back to you. All right, but time for me to let you go. Thanks for all the thumbs up. I can see now still 175 people watching. And as I refresh my button, my screen, I can see 64 people have already clicked a like. That's always appreciated. That's awesome. Thank you for doing that. That's like applause for your presenter. And it gives us a boost in the YouTube algorithm, helps more people find our webcast. So thanks for doing that. Everybody go have a great weekend. Ben, thanks for helping out. Definitely appreciate your assistance. I will see you all on Monday. I'll look for you in future webcasts. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.